Hello and welcome to Investing 101, Lesson 5, Asset Allocation and Diversification. In the last two lessons, we talked about the four major asset classes: stocks, bonds, cash, and real estate. Now we're going to talk about the importance of being diversified across and within these different asset classes.
Oh, goody.
Asset allocation refers to the way you divide your portfolio between the different types of assets. For example, you could have 60% of your portfolio in stocks, 20% in bonds, 10% in cash, and 10% in real estate. There is no perfect asset allocation that everyone should follow.
We wouldn't want to make things too easy now, would we?
Instead, each investor needs to tailor their portfolio to their own time horizon, goals, and risk tolerance. In general, the younger you are, the longer your time horizon, so having more of your portfolio in stocks and real estate might make sense. For older investors who are nearing retirement, having more money in bonds can help protect you from short-term downturns, and if you're retired, you might want to have an even higher percentage in cash. However, your investment goals are also an important consideration. If you have a high dollar goal for retirement,
it's a fine goal, to be sure,
and perhaps you didn't start as early as you would have wished, then you might need to keep more money in stocks longer, even as you age, because that's the only way you're going to get the return you need to reach your investment goals. Just remember that the greater your returns, the greater your risk, especially in the short term, and you might have to deal with a lot of volatility along the way. This brings us to another important factor when determining your asset allocation: risk tolerance. If you have a habit of constantly checking your portfolio and going into a panic when you see it go down, or if you have trouble sleeping at night because you're worrying about your investments, then investing in stock and real estate might not be for you, even if you're younger and have a long time horizon. In the last lesson of the course, I'm going to talk about some ways that you can manage your fear and overcome your worries about the stock market. But if that still doesn't help you and you still find yourself worrying constantly about your investments, then investing in risky things like stocks might not be for you. And that's okay. That doesn't mean you shouldn't invest. It does mean that perhaps you should stick to safer investments like bonds. Yes, that will hurt your long-term wealth, but it could also end up saving you, because if you panic and sell your stocks when they're really low, that's going to hurt your wealth even more. So even though your returns will be lower if you forego investing in stocks, the peace of mind you get from safe investments like bonds could be well worth the cost. So you've determined your asset allocation.
Oh yeah.
But you're not quite done yet, because being diversified across these different assets is only one part of successful diversification. You also need to be diversified within each asset class.
Bring it on.
So say you decided you wanted to put 80% of your portfolio into stocks. Well, should you have all that in one stock like Apple, or should you have it in a bunch of different stocks? After all, putting all your money in Apple should make sense, right? I mean, Apple's a big company, it's very successful, it makes a lot of money, and it's definitely not going anywhere anytime soon. So why shouldn't you put all your money in Apple?
Funny old world, isn't it?
Well, the answer, of course, is that it really compounds your risk. Now, you could make a lot of money investing just in Apple, but you could also be investing in the next GE, which lost 70% of its value from 2016 to 2019. Instead, what you want to do is invest in a lot of different stocks, spreading your risk across a bunch of different companies, so that you can still have a really good return, but you don't have to worry about putting all your fruit in one basket. The same philosophy applies to real estate and bonds. It's better to partially own a lot of different properties through a REIT than it is to completely own one or two. And buying bonds from a lot of different companies instead of just one will reduce your risk without reducing your return. In the next two lessons, we're going to talk about easy ways to get an instantly diversified, low-risk portfolio. We'll start with mutual funds and index funds.
Booyah!